Welcome to All Things Financial. Trey Peterson and Yelisey Coots, where we help you retire once so you can retire well. And today is part 2, talking about taxes in retirement, how to minimize your taxes, and how to maximize everything that you've worked so hard for. Join us today on how to maximize your retirement and minimize your taxes in the next phase of your life. Welcome to All Things Financial. Today is part 2 of strategizing taxes in retirement. And I'm really excited because today, one of the things that we're talking about is one of the most important things that you can do as you prepare for retirement, which is how do you make sure that you pay all the taxes you owe, but you don't spend $1 more. And I think one of the areas that we see a lot of people miss it, or a lot of people where they don't have an expert to run things by, is they have a financial advisor, they have a tax preparer, but they don't have a tax strategist. I think one of the things that we do really well, one of the things that we've worked hard to do is not just have a wealth management office, but to have a home office. And really explaining to people that means that you can do your investments, your taxes, your insurance, and your estate planning under one roof. And today what we're going to talk about is how do you minimize tax in retirement. We talked about some 3 key components in our first episode, but today's episode 2, and excited to jump back into one of the most important pieces that people need to prepare for retirement. What are you looking forward to today, Yelisey?
I think one of the simplest and easiest recommendations that we can make, especially for those before they get to retirement, is just to make contributions to their employer-sponsored plan. Mm-hmm. Now, I know there's way more options than there used to be. Most of the time, we're talking about 401ks, but we know there's 403bs, TSPs, TSAs, 457s. There's all kinds of different employer-sponsored plans. We'll just refer to them as 401ks, going forward, just to make it easy. But you can contribute to a 401k. And the year that you contribute, it'll lower your taxable income in that year. That's a very attractive thing for anyone, especially as your income grows. It becomes more and more appealing to lower your income because you might be going into a higher tax bracket. So I would say that would be my number one piece of advice for most people.
Well, I think what we're going to talk about is tax diversification. So, you might be somebody that you've saved really well, but it's all pre-tax.
Yeah.
You might be somebody that has a mix. You've got pre-tax, you've got post-tax in a brokerage account, and you got Roth. And your spend down plan would look very different depending upon the pieces that you have for retirement.
Yeah.
So we'll kind of talk about both of those. I think we start with number 1 is just diversification. So let's say that somebody is 10 years or 15 years or 20 years in retirement. One of the things we would say is don't just fill the pre-tax bucket, but create diversification. What does that mean? Open an individual account or a joint account that you're funding with after-tax dollars so that in 10 years, you've got another bucket of money that gives you more flexibility.
And by the way, I think even the IRS is aware that that's beneficial for people. So there's this new provision that just started in, I think it was either last year or maybe it just went into effect this year, where if your income is above $150,000 and you're over the age of 50, right? You have to be over the age of 50 and your income's above 150 grand. What they do is they force your catch-up contributions to go into a Roth 401k. So if you're still contributing to your employer plan, that's great. You can do your 401k, but if you make more than $150,000, they're forcing it to be a Roth catch-up contribution. So that's kind of a nice thing because, it's tempting to always go into the 401k because it lowers your tax bill. But the Roth IRA is going to have bigger implications down the road because none of those dollars will be taxed in the future. The growth won't be taxed either. So I think that even within the tax code, we have some provisions that are forcing people into that direction.
If someone's saying, right now I'm doing all pre-tax, should I be doing some Roth also, or how do you decide when to add some Roth in there?
Like I said, it's a very tough thing to look at because when you're doing the Roth contributions, or maybe you have a Roth 401k, or maybe you're just contributing to a Roth IRA, there are some limitations. And in the previous episode, we talked about somebody who had $1.5 million in a Roth IRA. Well, there's really only 2 ways to do that. You can contribute to one, but there's income limit. If you make too much money, you can't even contribute.
Right.
So what a lot of people do are Roth conversions, right? Because there are no limits on conversions. And I think, you have an excellent story about Roth conversions where they kind of went south in the wrong direction because of some bad advice. But I think that when you consider Roth conversions, you're really making a long-term decision. You're prioritizing a couple of things. You know that in the future, even though you have less money to work with, in the future, all of the gains, all the earnings will be tax-free. And we have some of our clients who prioritize that because they want to pass money on to their kids and they want their kids to get it tax-free.
So we're talking about Roth conversions. Let's just talk about what that is. So a Roth conversion is where you take money out of a pre-tax account, 401k, 403b, everything we've talked about.
Yeah. So
you actually pay the taxes on that money.
Yes.
Even though you're not getting a new car.
Yep.
You're not updating your house. You're not increasing your lifestyle, because you're paying the taxes and you're taking what's left and you're adding it into a Roth account. Now, there's two ways to do that. You can pay the taxes out of the money that you took out of the IRA. But in an ideal world, if you're diversified and you have a brokerage account or a lot of savings, you would pay the taxation out of that so that everything that comes out of the 401k or IRA can go into the Roth. But what we'd also say is you don't want to just convert. Typically, you wouldn't start until you have a reduction in income or until retirement. So timing matters.
Timing matters. In the years of like where your income is low, maybe in the early years of retirement, I mean, that's the best spot. That's the sweet spot.
Yeah. So we'll talk about tax bracket management in a moment. The other piece, though, is it's not just about converting those dollars, it's timing of using the dollars. So everybody knows that if you contribute to a Roth account, you can't touch it for 5 years.
Yeah, and there's some caveats there that I actually wanted to touch on. So you can always take out the money you contributed. The way the IRS views distributions from a Roth IRA, they do it on a first in, first out basis. Well, the first thing you put in is your contribution.
Right.
So you can always take out the contribution, penalty and tax free. There's no issues with taking your contribution out. So conversions also have no tax penalty. They just have a 10% penalty if they haven't cleared what I think you were getting to, the 5-year table.
Yep. So here's the other piece, though. A lot of people know about the 5-year table. What a lot of people don't know is there's a lot of studies, and if you'd like one of those, we can send it to you, that tell you that show you that if you are to convert or if you are to add to a Roth, not only do you need to wait 5 years because of penalties, but you should wait at least 10 years.
Right.
And the reason for that is if you think about a farmer, if they've got 100% of the seed and they're sowing that, it's different than if they're giving up 20% and putting in the 80%. Now that 80%, when there's a harvest, they get to keep all of it. Or if they invest 100%, they got to pay taxes later. So one of the best ways I've heard people talk about this is if you're a farmer, would you rather pay taxes on the seed or on the harvest? Well, I'd rather pay it on the seed because the harvest is going to be greater.
Right.
But in order for there to be a benefit in a Roth conversion or even contributing to a Roth, depending on your risk level, even if you're aggressive, you really need to wait at least 10 years to touch those dollars. If you touch it in the 7th year, the 8th year, or any time before the 10, it's likely that you never should have done it at all. So one of the things I would ask is, are you having these types of conversations of, if I convert, what needs to happen following the conversion to make sure there's a benefit to converting these dollars?
Actually, I love that illustration. Really, another way to think about it is, how much did it cost you to make the conversion? Well, if you're a low tax bracket, maybe it costed you very little. If you're a high tax bracket, you're going to need that money to stay in the Roth for a longer period of time before you can take that distribution. Which maybe it's a great segue into the conversation on donor advised funds, the way that people offset Roth conversions and end up paying less for those because of things like a donor advised fund.
Yeah, and I want to give 2 examples before we hit the donor advised fund. So 2 things that we see. Sometimes we see people come in and they've never heard of a conversion and they should be doing them.
Right.
The other thing that we've seen is people that come in and they are doing conversions and they shouldn't be doing them. Meaning that just because something sounds good, or what I would say, just because something sounds sexy doesn't mean it fits you, because there can be 2 truths. It can be true that Roth conversions are a good thing, but it can also be true that they don't fit your situation.
Right.
So we've also seen where people are converting out of the 10 and the 12% tax bracket into the 22, 24 and above, but later in retirement, they're actually never past the 12% tax bracket. So it's very unlikely that they should be doing the conversions at all, but they've got somebody that's being so active because it sounds good to talk about, it sounds good to take action, but there are people that shouldn't take action on this.
Yeah.
The other thing that we've seen is people that are taking action, but they're taking too much action, and they're not doing tax bracket management, which means they're not just maximizing that 10 or that 12% bracket so that later they don't have to pay 22%. They're already converting over and above a bracket they'd never be in. So it reminds me of a couple that 2 years ago they came in and they said, hey, we've already started talking about conversions. We're just coming to get a second opinion on it. And I go, well, that's perfect because you guys have a lot of pre-tax dollars. And I said, what did your advisor recommend, that you're currently with? And they said, well, he doesn't have a tax advisor on staff. He's a financial advisor. So he actually has a relationship with somebody down the road and we pay, the CPA hourly. And I go, well, that's wonderful. What did they recommend? And they said they recommended that we convert $250,000 this year. Well, what was interesting is they were both still working. and he was a six-figure, employee, bringing in good income. She was making 70 or 80 some thousand a year. So adding another 250,000 put him in the 34% tax bracket. And I said, and you said, there's no way that he recommended that. If I were you, I would double check and sooner than later. In our appointment, they called, asked the advisor, how much had you recommended that we convert? The advisor, not knowing that we're sitting in the room, said, we recommended $250,000. The CPA that we brought in that you're paying $250 an hour recommended $250,000. And not only did we recommend it, we've got good news, Jim and Julie, we got it done. And we sat there and we were like, no way. And they said, well, what about IRMA? So IRMA is the income-related adjustment related to Medicare, because we had brought up to them one of the challenges is that now you're putting yourself in a income bracket that you're going to pay more for medical than ever before. When they brought up that to the advisor, he goes, well, I don't know anything about IRMA. I'm not a health insurance or a Medicare agent. Well, what about the CPA? Well, he's a CPA. He's not a Medicare agent. So one of the reasons why you need all of these people on your team working together is because they might specialize in their arena, but how does it impact every area of your retirement? So then here's what happened. The advisor said, well, if you feel like we did too much, we converted too much, good news, we can put some of it back. And I asked the couple, please put your phone on mute. And they did. And I said, you can't put it back. They took that away several years ago,
right,
where you used to be able to do something called recharacterization. If you're taking notes, what is recharacterization? If you over-converted, you had until April 15th of the following year to put it back. They took that away. Their advisor's on the phone, not knowing that that was taken away, telling them they can put it back, and he's going to hang up, do a little homework, and get back to them. They hang up, and we go, hey, guys, we've got bad news. There's no putting it back. That $250 has been spent. And here's the kicker. People go, well, is there any way they did the right thing? And I said, well, not only did they push themselves into new IRMA charges, not only did they push themselves into a tax bracket they'll never be in, the other thing they did is they relied on and they paid extra for a CPA. I said to them, well, I wouldn't blame your advisor. I would blame the CPA because he's the expert in this area. And they go, well, that sounds nice, but our advisor confirmed for us that he personally looked into this and that he recommended it also. And then she said, it actually gets worse. And I go, how does it get worse? She goes, our advisor is my brother.
I love the story.
And so the reason I share that story is because obviously their advisor and her brother wanted what was best for them, but he was walking into an area that he didn't have expertise. So one of the things I just want to say before we move on is if you're considering Roth conversions, please get an expert opinion from somebody that's either a CPA or an enrolled agent, and they've spent more than 5 years helping more than a few dozen people not just execute a Roth conversion, but to do it accurately.
It's not uncommon for advisors to have partnerships with CPAs, estate planning attorneys, or maybe they have a referral source or something. But one of the things that the gentleman, you'll know who I'm talking about, what he said yesterday is, I can really tell that you guys do a good job communicating with your CPA, with your estate planning attorney, with the guy who does Medicare. You could just tell that the communication is really smooth between you guys. And this is something that I'm specifically looking for. So I thought that was a great compliment because it really is important to, sometimes you just want to take the credit. Yeah, sure. The CPA, this is what he came up with, and I looked it all over, and I 100% agree, when you really haven't even looked at it. And I think that's kind of what happened in that situation. But for us, we've always prioritized that level of communication where it's like, hey, we're not just, giving advice in a vacuum. We're not we're actually talking to the CPA daily. We're bringing him into our conversations, sometimes into the meetings with the clients. So we're having these conversations, and I think that that's really important.
So let's move into what you wanted to talk about.
The donor advised fund, we've had to kind of reframe the conversation on this because of the big, beautiful bill, some of the changes that have taken place. So basically this family, they gave $10,000 a year to their favorite charity. They've always given $10,000 a year, and they did it just from their checking and savings account. What I suggested was, hey, why don't we take $100,000, move it to a donor advised fund? There's a huge tax benefit for doing it. You get the entire $100,000 deduction in year one, but you can continue giving $10,000 a year to the charity for the next 10 years if you wanted to.
Right.
In fact, you could change charities. You could skip a year. There's nobody telling you that you have to give to the same charity. There's nobody telling that you have to continue giving $10,000 a year. But since you've already been doing $10,000 a year, just give $100,000, take the full deduction in year one, And then the charity gets exactly what they've been getting for all these years.
Very good.
Now, the nice thing was, the reason why I recommended it is they wanted to do a $100,000 Roth conversion. So I'm like, hey, we'll do the $100,000 Roth conversion. We'll introduce $100,000 of taxable income, and we'll simply offset it with the donor advised fund. In other words, it allows you to bunch those contributions to charity into the first year and get the immediate deduction. Great story, great opportunity for a lot of folks, especially for already giving charitably. The difference is the One Big Beautiful Bill made some changes in 2026. The best way to fund a donor advised fund traditionally has been with highly appreciated stock. Imagine you bought Apple here. Now your Apple stock is worth a ton of money. If you sell it, you have to realize the capital gains. Well, the nice thing is you give it to the donor advised fund. They sell it immediately and you get the entire value of that. You don't have to realize the capital gains. So highly appreciated stock has been like the go-to source for donor advised funds.
Yeah, very good.
Well, now it's limited to 30% of your AGI. If you give highly appreciated stock, imagine you have $100,000 in adjusted gross income. Your limit's 30 grand on the deduction. So you can give a lot of money if you want to, but it's limited to 30% of your AGI.
Yeah.
The problem is they're incentivizing the wrong thing. If you give cash, you get to deduct 60% of your AGI.
Right.
So now more people are I guess, more prone to either not doing a donor advised contribution because, well, the cash is more valuable and it's not as valuable to give the highly appreciated stock. So that's one thing that's kind of changed. It's still obviously a very valuable tool and an excellent way to, if you're already giving to charity, and by the way, if I haven't already mentioned this is on after-tax dollars. So if you're wondering how do I fund a donor advised fund, it'll be with after-tax dollars, and still an excellent way to offset some of the income from the Roth conversion. Another way to give charitably is a qualified charitable distribution. So this was it used to coincide with the RMD rules way back in the day. So it used to be that at 70 and a half, you'd have to begin taking required minimum distributions. And then they moved that to 72 and then eventually to 73 and 75.
Yeah.
But the qualified charitable distribution rules remained at 70 and a half. So as soon as you reach 70 and a half, you can actually begin taking distributions from your traditional IRAs. And you can send that money to charity. And this year it's $111,000 per person. So you can send a huge amount to charity from your IRAs.
Yeah.
And you don't have to wait until RMD age. You can still give it at the age of 70 and a half. And here's the biggest benefit compared to a donor advised fund. Like if you're 70 and a half and you have pre-tax dollars, I would say that you could still do the donor advised fund, but it might be better to do the qualified charitable distribution because it's an above the line deduction.
Yeah.
In other words, you don't have to compete with a standard deduction. With a donor advised fund, like in my example that I gave, if you have $100,000 in adjusted gross income and you're only taking $30,000 from the donor advised fund as a deduction, you're not even going to use it. You'll just take the standard deduction of $32,200. Because it's greater. With a qualified charitable distribution, it's an above-the-line deduction. It's totally excluded from your taxable income. In other words, you can still take the standard deduction of $32,200 for those that are married, and you can give it to charity and exclude that from your taxable income up to $111,000 per person. So the whole point of all this, whether it's the donor advised fund or the qualified charitable distribution is, if you're already charitably inclined and you're giving, don't give from your checking and savings. That money's already been taxed. Give from different sources that allow you to get money out of the IRAs without paying anything in federal income taxes on it. So that would be my 2 cents on charitable giving.
I think the other thing you say this well and often is if you're already charitable, it makes sense.
Yes.
If you're not charitable, you're still having to give the money away, so it probably doesn't make sense. So if all of
maybe
your funds,
become charitable.
Yeah. No, but
it's funny when we have clients who give $50 a year and they think they're very charitable,
there's not a right or wrong, it's preference. If your charity is your kids because they need the funds, then we fully understand that and we want to help that money go to them. And there are additional things or other things that strategically we could help you with.
Yeah.
So whether you are charitable or not, our goal is to help you minimize your taxes.
One last thing that I wanted to mention, and this is something that we've had a lot of questions on. So there's this rule called the 30-day wash rule. So basically, if you have an after-tax account, and the nice thing about after-tax accounts is it's full of positions that have gains, and some of your positions have losses. And the nice thing is if you sell off positions with gains and losses, they offset each other, right? So you might say, hey, you know what, like I mentioned previously, you have Apple stock, it's really high. If I sell it, I'm going to realize the capital gain.
Yeah.
Unless I sell a position with a loss, then I can totally offset that gain. But what some people have noticed, and this is years ago, that if I sell a position with a loss, I can offset my gain but what if I still want that position? So they quickly go and repurchase it.
Right.
Well, the IRS says you can't. Hold on a second. You're gonna violate the 30-day wash sale rules. So you can't repurchase the same position within a 30-day period. It has to be a very different position. So one of the things that we've done, and this is, this is not gray area at all, but this is something that's very much allowed, right? Where we have some opportunities where the market dips, we do something called tax loss harvesting, where we actually sell the positions with a loss on purpose to help offset some of the gains we may have generated. So for instance, like if you end up, let's say you have NVIDIA stock in your portfolio, there's no reason why you can't sell NVIDIA at a loss and then buy an ETF, like a semiconductor ETF, that's mostly comprised of NVIDIA. It's a totally different category, going from an individual stock to an ETF. So that's one way that you can actually take advantage of some of the losses in your portfolio to offset some of the gains. Or in some ways, if you, let's say you have an S&P 500 ETF, you can sell that ETF and buy like a broad market index ETF or something like that, where you can do that and you don't have to wait 30 days to do that. So that's one way to take advantage of existing losses in your portfolio, especially if you're looking to mitigate taxes in the current year.
If somebody's in near retirement and they go, hey, I'm 7 years out from retirement, is that too early to start talking about tax planning?
I would say that the sooner the better. Like the more time you give yourself, the more options you give yourself. It's that simple.
One of the things I would say too is if you have been just putting your head down and you've been saving and you've got a handful of things that you're not sure about, now is the time, because some of the recommendations we can make is, do you start a Roth if you haven't? Do you move some of the pre-tax dollars into the Roth? And some of the things that play into that is based on your expenses, based on when your spouse retires, based on your long-term goals. Is your goal that you give as much money to your adult kids as possible? Or is the goal that you bounce the last check because they make more money than you do and they don't need it?
Right.
And so all those variations could really help us determine what people should be doing based on their specific situation. And I think one of the things that I like is that we don't just have somebody that's a tax preparer that's telling you what's really safe. They're actually showing you as an enrolled agent what areas you can push the limits, and not illegally, but what areas can you be aggressive and what areas do you need to be conservative. And I think what's really important is that people understand is that if you have an enrolled agent or somebody that really understands what the IRS wants you to accomplish, they're doing a really good job of helping you maximize the rules. And one of the things that we like to say is, if there's rules in place, we want to follow the rules, but we want to know what they are. And I think our team does a really good job of helping people know what areas can we help you and what areas are you already taking advantage. We've got a gal that she did her tax return with somebody on our staff last year. And she called me so upset. And I was like, man, I've never had anybody upset with our tax team. And she goes, when I met with your team member so-and-so, he got me a tax return on my property taxes. She goes, I'm so mad. That's never happened before. I want to know, like, is he doing something illegal? So I was like, I've never had anybody mad to get more money back than they've ever gotten back before. So I called, our tax guy, and I won't say his name on air because we've got several of them, but I said, hey, so-and-so, she's mad about this. And I go, why has she never had a tax return on her property taxes before? And he goes, because in her whole career, she's never filed a tax return on her property taxes. She's only done income taxes. And so here she got back, it was like almost $300. And she was mad when she hadn't known that nobody had ever filed a property tax return, and we did it for the first time. Yeah. So if you've never had a second opinion on your tax return, one of the things we'd love to do is send it in. We'll have one of our tax members review it, pick through it, and they'll either tell you that everything looks great, you're doing everything we would do, or if there's areas that could be improved.
I really like episodes like this where we discuss a lot of different potentially options for people. But here's the one thing that, that really makes a difference. Like if you find somebody who really takes the time to understand your specific situation, none of these strategies apply across the board. And some of them absolutely aren't in your best interest, just like you mentioned with the Roth conversions. For some people, it makes sense. And other people are just fascinated by like this new thing that their advisor mentioned. And they think they're doing tax strategy, but they're actually harming themselves either in the amount or just maybe they shouldn't be doing them all together. But the point is finding somebody that like knows your specific situation, that understands, hey, like, is there an age gap between you and your spouse? What are your priorities? Like, are you looking to pass money on, or do you have children with special needs.
Right.
Like, what are you looking to do? Are you hoping to give everything away to a charity eventually? Or do you want to make sure you spend the last dollar? Like, all those are going to influence your decision. And not only that, like, we all have different sources, right? Some of us plan on having a part-time job in retirement, and sometimes that part-time job ends up being substantial. Others, maybe we have $1.5 million in a Roth IRA or between several Roth IRAs. But, and some of us are maybe limited to maybe one source of income. Maybe it's just a pre-tax account. It's really going to influence your decision. And I would say, finding somebody who's competent, we could share, I would say, dozens of additional tax nuggets and strategies that we could probably help people with. But I think some of the ones that we talked about today are really essential and could really help a lot of folks.
Yeah, wonderful. Well, if you are in and nearing retirement and you've never had a spend down plan, if you've never talked about Roth conversions, if you've never had someone you can sit down with and say, how much should I be contributing to a Roth? Does it make sense in this season? We'd love to help you with that. Thank you for joining us for this episode. I hope you're getting a lot of value out of them. I hope you check out some of the others. And we know the best is ahead. Thank you for joining us.
Advisory services are offered through CG Advisory Services, LLC, a registered investment advisor, and through Guardian Wealth Strategies, LLC, a registered investment advisor. CG Advisory Services, LLC, and Guardian Wealth Strategies, LLC, are separate and unaffiliated entities. The topics discussed on this podcast are for educational purposes only and are not intended to be investment advice or recommendations. Listeners should consult with their own financial professionals before making any investment decisions.